Hello everyone, today we will explore a very important but often overlooked concept in accounting called the articulation concept. This concept helps us to understand that how different financial statements are not just separate reports but they are connected like puzzle pieces. By the end of this lecture, you will clearly see how the income statement, balance sheet and cash flow statement talk to each other and form a complete financial story of a business. So let's start by understanding the word articulation. What does it actually mean? The word articulation simply means joining or connecting. In accounting, the articulation concept means that financial statements are not created in isolation, they are deeply connected. What happens in one statement affects the others. For example, profit from the income statement flows into the balance sheet as a part of retained earnings. Similarly, cash shown in the cash flow statement must match the cash balances in the balance sheet. So everything is part of one big financial picture. Now let's see how these statements are connected. First, when a company earns a profit, we see that on the income statement. And this profit doesn't just disappear, it is added to retained earnings on the balance sheet, showing a link between a income statement and a balance sheet. Next, the cash flow statement shows actual cash coming in and going out. The final cash balance here must match the cash amount shown in the balance sheet. So you can see that balance sheet and cash flow statements are also connected with each other. Also, some things like depreciation reduce profits but are not actual cash outflows because it is a non-cash expense. So they are removed in the income statement but added back in the cash flow statement. So there is a link between income statement and the cash flow statement. This way all three statements are constantly talking to each other. Let's take an example for better understanding of this articulation concept. Suppose ABC traders made a net profit of $10,000. If they don't pay any dividends, this amount will be added to retained earnings in the balance sheet. So out of this profit, they generated $7,000 in actual cash. The rest might be tied up in credit sales. So this $7,000 will appear in the cash flow statement and will increase the cash balance in the balance sheet. So again we see how all these three statements are closely linked to each other. Now question arises that why articulation is so important. The articulation is crucial because it ensures all statements are consistent. If one number changes, it should reflect in the related statement. For analysts, investors and even managers, understanding these connections help in making better decisions. It also helps in detecting errors or fraud because if the numbers do not add up across statements, something might be wrong. It's time for a recap activity. Let's do a quick check on what we have learned. I'm going to give you a few events and you will tell me which statement it affects. So let's start with revenue earned. When revenue is earned, where does it go? Which statements are involved? Yes, it does affect income statement, balance sheet and cash flow statement. What's about payment for the equipment? It does not affect income statement, but it does affect balance sheet and cash flow statement. And what's about the depreciation records? It affects income statement, but it also affects balance sheet as well as the cash flow statement. That's all about today's lecture on articulation, and I hope you would have enjoyed today's lecture. So let every concept spark your curiosity and confidence. Stay tuned and keep learning and subscribe to Concepture Academy for more stimulating lessons. So until next lecture, take care and goodbye.